Hello traders, Gary Wagner here. It is 11:35 in Honolulu, 4:35 in New York on Tuesday, 10th day of December 2024, and this is the evening report for gold and silver. Gold had a tremendous gain today, about $38, taking the most active February contract to its current price at $2,720. That happened concurrently with dollar strength. The dollar opened at 106.13 and closed at 106.30 for a moderate gain on the day. If you recall from yesterday's show, I did make a recommendation. We'll talk about that in a second. But what has been interesting and honestly perplexing has been the way this correction has unfolded. There is absolute certainty in terms of our Elliott wave count about the impulse phase, waves 1 through 5, beginning in October of last year with gold trading at just below 2,000 up to this all-time record high. Every one of these impulse waves are very, very clean. But typically when it comes to a corrective phase, not a wave 2 or 4, but a corrective phase, it will typically unfold as a zigzag more often than a compression triangle. Typically the reason you get the zigzag is that on a compression triangle, if we look at the last one, the price correction that ensues from a triangle pattern is typically much less than a zigzag ABC. Because if we look at the differential from the low, this comes in at 2,096, to the high of just that wave 1 is 2288, but it will then contract because you'll get a series of lower highs and equal lows or higher lows until you get the completion and then the thrust. However, when we get a straight ABC correction, which is what I thought was playing out right here, meaning our A, our B, and our C, we will typically have the C at least go to a flat, meaning 2567 it will be equal to, but more likely it would have come down to about 2522. And the biggest shortcoming is that markets are fundamentally based, they're controlled by events, and we're looking at math and symbols rather than the events themselves for patterns or occurrences in the past that give us insight into the future. Which brings me to the trade recommendation I issued yesterday. Because we didn't send it out in writing, we don't call it a trade alert, but nonetheless, I'm hoping that many of our self-managed accounts that call their own shots but use our information to guide them were able to look at the setup I was talking about and take advantage of that, along with those that do take trade alerts would possibly think about entering it. And the reason that I felt that this was so likely is the tremendous sell-off we had for what we're labeling as an A, the perfect B wave that came below 75 and above 50, but this absolute failure of the C wave to at least go to a flat. It had that tremendous $90 sell-off, but then traded within a range of about $30. I'm looking at the bodies, not the wicks. Yesterday was significant. It was significant because it closed above 2675. That is where the tops of all of these real bodies have been for over the last 9 days. Today we had the significant breakout, and once it broke above this resistance trend line, we said that it would be best to buy the breakout. In terms of a stop, you want to put it below today's low, so below 2679.70. This has been Gary Wagner wishing you, as always, good trading. We will talk to you tomorrow for the next daily update and review. Bye-bye.